Hello, everyone. My name is Joshua Villegas, and I'm attending American Military University, and I'm currently in Dr. Schreiber's Business 604 class. Today, I'll discuss the correlation between sensitivity analysis, project risk, and capital budgeting. These three are interconnected in the financial decision making process. To better understand these topics, I will discuss sensitivity analysis and project risk to show how they play a critical role in capital budgeting. So, what is sensitivity analysis? Sensitivity analysis helps estimate how changes in input variables affect the outcome values. It shows if outcomes depend on certain variables to provide the desired outcome. Quantitative and qualitative data are used in sensitivity analysis to assess the changing variables. It enables companies to make sound decisions by assessing the possibilities and accounting for their associated risk in uncertain conditions. Sensitivity analysis depends heavily on data collection to create scenarios to help quantify the changing variables. Examples of data sources are historical records like previous projects, market research, or expert opinion. So, what is quantitative data? It's number-based data that can be easily replicated numerically. This data can be accounted, compared, and replicated by others using the same numerical data. Quantitative data answers the questions of how much, how often, using calculations. Quantitative steps are data collection, identify the independent and dependent variables, determining appropriate attributes, levels of measurement for each variable, provide a framework for understanding and managing the data collected, determining the scenarios, and conducting the analysis. Qualitative data is interpretation based, descriptive, and related to language. This data may be more complex to replicate since the data is based on an individual's interpretation. This data helps answer the questions why, how, or what happened after a specific behavior. Qualitative steps are identifying variables or approaches that can influence outcome, choose the input variable or approaches to modeling that are most important, define scenarios, choose the range of alternative values or models that will substitute the qualitative data, choose which techniques to use to analyze uncertainties and apply them, evaluate the risk, interpret the findings. Both qualitative and quantitative data used in sensitivity analysis can estimate the effects input variables have on outcomes. You will be able to see if the desired outcome is dependent on a specific variable. Project risk. Project risk is the potential events or situation that can hurt a project's impact, its objective, timeline, budget, or success. This can also be in the form of uncertainties that, if they occur, can deviate from the project's objective. Things like the discount rates calculations can have a different degree of risk associated with each specific project. Risk will always be involved, so it's essential to classify risk based on the level of risk they impose on the program, project, or company. Risk can be financial, strategic, performance, or external. Financial means raising material costs or budget overages. Strategics are projects are depending on other projects or other projects are depending on the current project to be successful. Performance are poor sales or poor marketing. External could be changes in laws, regulations, or changes in the market. Risk assessment steps are identifying the risk, validate the risk, prioritize the risk, identify risk severity, identify mitigations or mitigating conditions, quantify the risk, lastly, document and organize the risk. After collecting the risk data, it can be used in sensitivity analysis. A project risk can be incorporated into capital budgeting through sensitivity analysis by using quantitative and qualitative data associated with the project risk variables. Sensitivity analysis can help estimate the outcomes and effects of each variable. Project risk incorporated into sensitive analysis help identify critical risks that affect the project's success. It can help quantify the impact of the risks identified, enable companies to run scenarios to examine each risk variables, best and worst case scenarios, improve decision making under uncertain conditions, and improving the risk management. Sensitivity analysis identifies the impacts of the project risk and provides information to make educated decisions to properly allocate resources and account for them in the capital budgeting analysis. This concludes my presentation and correlation of sensitivity analysis, project risk, and capital budgeting. Thanks for your time. Have a great day.